the friend of a friend tip. Let's be honest, in every coffee shop, every family barbecue, and definitely in every gym locker room, you'll find that one guy. He's not a financial advisor, he sells insurance, or maybe he installs solar panels, but he has a sure thing, a stock that's about to moon, a crypto token that's undervalued, and you, holding your protein shake, start to listen. This is the original sin of bad investing. You are confusing a cocktail party anecdote with actual due diligence. The visual here is a sweaty man in a tank top drawing a rocket ship on a napkin while you nod along. That napkin is now your investment thesis. You didn't check the balance sheet. You didn't look at the management team. You bought a story, not an asset. And when the story turns out to be fiction, your money is gone. Remember, if a stranger in a sauna knew how to get rich, he wouldn't be selling you the secret for free. He'd be on a yacht. Checking your phone every 5 minutes. You bought a solid stock, a good company. You did your homework. So you install the trading app, and you check it. Just once. Then you check it again an hour later. Then you check it while brushing your teeth. Then you check it in the middle of the night when you get up to get water. The visual is you, in your pajamas, phone light illuminating your face, watching a number tick down in the red. This is the death by 1,000 cuts strategy. You aren't investing. You're gambling on a slot machine that happens to be in your pocket. The problem isn't the company. The problem is your adrenal gland. You see a 2% drop and panic. You see a 3% rise and you get greedy. You sell low out of fear, and you buy high out of FOMO. Your screen is your enemy. Turn off the notifications. Close the app. Good investments are like slow-cooked barbecue. You don't open the lid every 5 minutes or you let all the heat out. Ignoring the tiny fees. You made a profit. Congratulations. You sold at the top. You're a genius. The visual shows you doing a little victory dance in your kitchen. But then, look at the trade confirmation. Look at the brokerage statement. See that line? The commission, the spread, the management fee. It looks small, right? It's just a tiny slice of the pie. But here is the horrible truth about compound interest. It works both ways. A 2% fee doesn't just take 2% of your money. It takes 2% of your future growth. Over 20 years, that 2% fee can eat up to 40% of your total potential profit. The visual is a giant pie chart, and a tiny little fork just keeps taking slices until the pie is gone. You are basically working for the bank. You are the farmer, and the fees are the locusts. You need to think about fees the way a sailor thinks about barnacles on a hull. They might seem small, but they slow you down until you are dead in the water. Putting everything in one place. This one is for the person who falls in love. Not with a person, but with a stock. You put all your money into it. You love the product. You wear the t-shirt. You tell your friends. The visual is you, wearing a t-shirt of a specific company, surrounded by their merchandise, staring at a laptop with a single stock graph on it. This is the basket mistake. You have all your eggs in one very fragile, very flammable basket. Now, let's say the CEO does something stupid, like tweet a bad joke or start a social media war. The stock tanks, your life savings tank. You didn't just lose money, you lost your entire safety net. Diversification isn't just a buzzword, it's the only free lunch on Wall Street. You want to be a general, not a foot soldier. A general spreads his forces across multiple fronts. A foot soldier charges one hill and gets shot. Put your money in different sectors, different countries, different asset classes, cash, bonds, real estate, and yes, that one risky stock you love, but only a little bit. Chasing the big, shiny dividend. You see it on the screen, a dividend yield of 8%, 9%, 10%. It looks like a beacon of hope in a low-interest world. The visual is a big glowing green button that says easy money with cartoon dollar signs floating around it. You press it. You buy the stock. You expect a check in the mail. But wait, if the yield is that high, it means the price is probably falling. The visual splits. On one side, you get a nice little dividend check, let's say $50. On the other side, the stock price is dropping like a stone, and you lose $500. This is the dividend trap. The company is paying out more money than it can afford to. They are eating the seed corn. They are selling the furniture to pay the rent. They are trying to look healthy while bleeding out. You didn't invest in a cash cow. You invested in a dying animal that is trying to give you the last drops of its milk before it collapses. It's tempting, but a high dividend is often a red flag, not a green light. It's a lure, and you are the fish. Holding on just to break even. This is the painful one. You bought a stock, it went down, it keeps going down, but you don't sell. Why? The visual is a jail cell, and you are sitting inside it, hugging a stock certificate. You say to yourself, I can't sell now, I'll lock in my losses. So you hold, and the stock goes from $100 to $50, and then from $50 to $20. You don't sell because you want to break even. This is the sunk cost fallacy. You are clinging to a fantasy. That money is gone. The market doesn't care what you paid for it. The stock doesn't know you own it. The company isn't trying to get you your money back. You are sitting in a burning house because you paid a lot for the painting inside. Get out. The visual should be a do not sell button that's taped down, and you are helplessly watching the number disappear. The smart money doesn't look at the price they bought at. They look at the price it is now and ask, is this a good investment today? If the answer is no, you cut the cord. The loss is already there. You're just refusing to admit it. So there you have it, the 6 horsemen of the investment apocalypse. Hot tips, phone addiction, fees, lack of diversity, fake yields, and that stubborn pride that makes you hold a loser. Investing isn't about being right all the time. It's about managing risk and avoiding these stupid, avoidable mistakes. Be a student, not a gambler. If this saved you from a terrible investment decision, give it a like and subscribe. Thanks for watching.